It is now my pleasure to turn today's program over to Brian Ward, Head of U.S. Specialty Sales at Legg Mason Asset Management. The floor is yours.
Thanks so much, Kelly, and good afternoon, everyone. This is the third quarter Legg Mason ClearBridge Investments Anatomy of a Recession webcast. Again, my name is Brian Ward, and I'm one of the sales managers here with Legg Mason Global Asset Management. And on behalf of everyone here at Legg, I want to welcome you to today's event with ClearBridge Investment and their investment strategist, Jeff Schulze. So we know that there's so many of you on the phone and listening in or on the webcast today that are existing clients of ClearBridge. So I'd like to start off by saying thank you so much. And we know you're familiar with that organization. For others, real quick, ClearBridge Investments is our largest leading equity global manager with roughly $140 billion in assets under management and a 50-year heritage, with a plethora of offerings that any number of our sales folks can talk to you about on a daily basis. So thank you to all our participants, as we realize that you could dial into any call, you could ignore any call, and you chose to join us today, and we really appreciate that. So last week we released the third quarter Anatomy of a Recession presentation, including the updated Recession Risk Dashboard, and distributed that to almost 30,000 financial advisors that are now part of our growing community. Now, if you're not part of this subscription currently, again, you can reach out to our desk, you can reach out to anybody that you partner with out in the field that works at Legg, or you can visit our website at www.leggmason.com. It's real simple, /AOR for Anatomy of Recession to subscribe. So real quick, I think it's noteworthy to point out that after countless AOR meetings, from Jeff speaking on the main stage to the daily one-on-one, whether they're phone appointments or in-person one-on-one appointments, from what you've told us, the Anatomy of a Recession is being utilized in a number of ways. I just want to touch on three. One, it's helping you, gather facts that you can use with your clients, providing potential lead time to a recession. So, great points that you can utilize as lead time. Secondly, helping you to sort of simplify your message with your clients when navigating through, the complexities of the market, especially when you're looking to make potential portfolio decisions. And lastly, which really ties to two as well, is helping to provide you with salient bullet points on a variety of topics. If you've seen the number of slides that we typically show, a variety of topics that can be used with clients when looking to make portfolio adjustments. In other words, helping to answer the why in what you're advising on. So as you've already witnessed, we're going to have polling questions. So as these questions pop up, please look to answer them, and then we'll come back and discuss. Jeff has roughly 20 minutes of prepared commentary, and then we'll turn it over to your actual questions. So with that, again, we thank you for your time, and I'd love to turn the call over to Jeff Schulze.
Great, Brian, and good afternoon, everybody. Thank you for dialing in to the Anatomy of Recession third quarter update. And I'm sure everybody is aware that this is the longest expansion in U.S. history, officially as of this month. We hit our 121st month of expansion against all odds coming out of the Great Recession. And the key question, obviously, at this point, is this late cycle? Are we getting closer and closer to the end? And the one thing that I can say definitively before I get into my prepared comments is that risks are rising, economically speaking. And obviously, the program that we put together is Anatomy of a Recession. And the reason why we focus on a recession is because recessions typically coincide with what we call market crashes. Now, there really isn't a textbook definition for a market crash, but we like to think of one as a bear market that lasts longer than a year. Those longer drawdowns, those ones that shake people out of their asset allocations right when they should be buying. And on the top left-hand side of this chart, you can see that we've had 6 market crashes since the early 1960s, so roughly the last 55 years. Importantly, 5 out of 6 of those, which are the dark shaded bars, coincided with a recession. Now, just to hammer this point home, we went look back at that same 55-year period, and we looked at every other large drawdown that happened, and we put them on the right-hand side as pullbacks. And we recently added the pullback that we saw in the fourth quarter of last year because we have reached new highs. Now, when you compare the 6 crashes versus the 7 pullbacks, we come across 3 distinct conclusions. On the bottom left-hand side of the chart, you can see that your average market crash lasts 3.7 times longer than your average pullback. Your average crash lasts a little bit over a year and a half versus your average pullback at less than half a year. In the middle, you can see that your average crash has a drawdown that's 2.3 times more severe. So the S&P 500 typically loses 42% in a crash versus 18% for a pullback. And then lastly, and most importantly, a market crash is 2 times more likely to coincide with a recession. So the key here is whether or not we're going into a recession. And as I mentioned just a couple seconds ago, recession risks are rising quite a bit in the month of June. This is the ClearBridge Recession Risk Dashboard, a group of 12 variables that have done a really good job of foreshadowing an upcoming recession. And you can see that the overall signal turned yellow this month. The reason being is you saw degradation across several of the underlying indicators, and 2 in particular changed from green to yellow. You had manufacturing PMI new orders go from green to yellow this month, and you also had job sentiment go from green to yellow as well. And the important thing to note here is that both of those indicators are what we call soft data surveys. Surveys that are given to individuals to answer individually. And we think that this is a direct reflection of the uncertainty that's caused by trade wars. Now, looking into each one of these indicators, manufacturing PMI new orders went all the way down to a 50 level this month. Now, 50 is the level where it's neither expansionary or contractionary, but we think that there's going to be more weakness to come here, because if you look at the PMIs that are out there, and the PMI is essentially the business cycle. You can have several business cycles within a longer economic cycle. So this economic cycle that we've had here, which has been a little bit over 10 years, has had 3 business cycles, or 3 accelerations of PMIs, and then 3 decelerations of the PMI surveys. Now, importantly, when you have a PMI deceleration without Fed tightening before it, the manufacturing PMI new order level usually gets to a 49. That's a little bit lower than where we are today. But if you do have Fed tightening before that deceleration, manufacturing PMI new orders, on average, has gone below 40. So since we've had Fed tightening for the last couple of years, that means even at a 50 level right now with manufacturing PMI new orders, we think that there's a lot more weakness to come on this front. Now, moving over to job sentiment, and this is a little bit of a head scratcher for us, because if you look at most of the major data points from the labor market, most of them appear to be very strong right now. Last month's non-farm payrolls rose 224,000. However, the way that we look at job sentiment is we look at the Conference Board survey. This is a survey that's been going out there for over 50 years, and they ask participants 2 key questions. Are jobs easy to find, and are jobs hard to get? Now, at the very end of an economic cycle, jobs that are easy to find become less and less, and then jobs that are hard to get, that response rate increases. Now, over the course of June, jobs that are hard to get increased 4.6%. Now, I know that doesn't sound like a big jump for you, but if you look at the 50-year history of this survey, that's the 5th largest monthly jump in 50 years. Importantly, the 4 larger jumps that we saw with that particular question all happened in the middle of a recession. Now, this really doesn't jive with the one data point that I like to look at, is the fact that there's 1.6 million more job openings right now than people that are unemployed, and this is a U.S. record. So what we read into this is that businesses, due to trade war uncertainties, even though they have those job openings, they're reluctant to bring on that marginal employee. They're reluctant to spend that marginal dollar of CapEx until there's a little bit more clarity on this front. So again, we're going to be watching the data here over the next couple months to see whether this is an aberration or a troubling trend of a slower economic environment. Now, it wasn't just the 2 soft surveys, data indicators that we look at that went from green to yellow that saw some deterioration. We saw some deterioration within some of the hard data as well, specifically retail sales, housing permits, and then also truck shipments as well. Now, we got a really positive retail sales number today, so that helps push that a little bit more towards green. But given all of the deterioration that we've seen, the overall dashboard is yellow, and it's a solid yellow at this point. Now, the one thing I want to just hammer home here is that a yellow signal just means that recession risks are rising. It doesn't necessarily mean that the end of the cycle is upon us. Now, if you look at the dashboard's history, again, going all the way back to the 1960s, we've had 3 non-recessionary yellow signals that we call false positives. That was in 1995, 1998, and then also 2016. The stronger signal in being able to determine whether or not we're going into a recession is a red signal. We've only had 8 red signals. 7 out of 8 of those foreshadowed the upcoming recession. And the only false positive that we had on the red was back in the mid-1960s, where economic growth slowed all the way down to 0.2%. So yes, we've turned yellow. Yes, recession risks are rising, and we think a lot of this is due to the trade uncertainty. And right now, we think the probability of a recession over the next 12 months is 50%.
So Jeff, why don't we pause real quick? One of the questions we posed to the audience is, will the U.S. have a recession within the next 12 months? I think you just said 50%. Our answer came in at, the answer was no, at 75%.
A lot of bulls out there.
A lot of bulls.
Good. Well, I think at this point it really is a fork in the road, and we can go one of 2 directions. Now, the important thing to note is that when you had a yellow signal, whether it was one of these false positives that I just mentioned, or this was a recessionary yellow signal, the market continues to go up for the next couple of months. And maybe the best way to illustrate this is to look at the case study from 2006. The dashboard turned yellow in October of 2006, eventually turned red in August of 2007, but nonetheless, the market moved higher for the next year before peaking and rolling over into the next recession. So yes, recession risks are rising, but we really think that this means know what you own in your portfolios. Take this opportunity to upgrade in quality. Take this opportunity to move into some more defensive-oriented asset classes as we move towards the end of this economic cycle. Now, the one thing that I'll mention here is that we don't know if this is going to be a slowdown or whether this is going to be a recession at this point, but what we do know is that volatility is going to be rising over the next couple of years. This slide shows you that volatility generally lags a flattening yield curve by 3 years, and the yield curve has been flattening relentlessly since 2014, which means even though we've seen some volatile periods over the last 9 months with a 20% drawdown in the fourth quarter last year and a 6% drawdown last quarter, we think volatility is going to be rising, and you're going to get a lot more choppiness and some momentary pullbacks, whether or not we go to the left or the right, i.e. a recession or a slowdown. Also, seasonally, this is a higher time for volatility. If you look at volatility since 1990, you can see that July, August, and September tend to be the most volatile months. There's an old adage out there that says sell in May and go away. Well, that's for good reason, and I think a lot of this volatility is predicated on lighter trade volumes that you typically see during the summer. Now, there's a lot of reasons why we could have higher vol in the near term, and I think as we enter the second quarter earnings season, that certainly could be one reason, but the other reason is trade.
Great opportunity to look at questions again. So one of the other polling questions we had, Jeff, was, when will a China-U.S. deal trade happen?
Yep, so it could happen. Obviously, I'm more of a bear on a trade deal happening, but it may actually sound counterintuitive here. And I know everybody knows that the markets have sold off every iteration of a trade escalation that we've had, but literally the last 3 market highs that we've had, you've seen a trade escalation and the market sold off because of that uncertainty. And given the fact that we're near all-time highs right now, and we move into the summer months, I think that there's a high probability that we do get a re-escalation, because coming out of the G20 meeting, there is nothing of substance that says that a trade deal is on the horizon. And this ultimately reminds me of the G20 meeting that we had last year in Argentina in November. Breaking from that meeting, both Trump and Xi said that the trade deal was upon us, and due to different interpretations of the text, it ultimately led to a breakdown and the next escalation in the saga. Now, out of the G20 meeting in Japan, there was no progress on the thorny issue of enacting new Chinese laws against IP theft and forced technology transfer, which is a non-negotiable for a lot of the trade hawks that we have in the administration. So our base case scenario is that trade escalation will happen sometime over the next 3 months, and that last tranche of goods, that $300 billion worth of consumer-facing goods, is likely to see higher tariffs on it as we go into the back half of the year. Now, this is our kind of a recession scenario. What could cause the next recession? Well, I think it's going to be a combination of both decreased business and consumer confidence. And business confidence has been weighing down ever since the first tariffs were implemented back in early 2018. I think that's a key reason why you've seen some weakness in our job sentiment measure. I think that's why CapEx has come down. But also, if you think about consumer confidence, that's been one area where you've seen strength consistently for the last year and a half. However, as I just mentioned, if we don't get any progress on trade, that last tranche of $300 billion worth of goods has a 10% tariff put on it, let's say. That means everyday goods like sneakers, clothing, electronics, those are going to be more expensive, and that could cause consumers to get less hopeful about their current situation, stop spending, and if businesses and consumers stop spending at the same exact time, that's when you can have a decrease in economic activity and ultimately a recession. Now, if you think about a trade deal, I think that there's a timeline that a trade deal can be forged, and I think that deadline is going to be Q4 of 2019. The reason being is that as we get into 2020 and we get closer and closer to the election, the Chinese are likely to give less and less concessions, and that's going to be a weak deal that will probably not play well politically heading into that election cycle. Also, if you have a trade deal closer to the election, even though that could be called a win for the Trump administration, it gives less time for a positive boost to the economy and consumers to ultimately feel that in their paychecks with higher economic activity. So I believe that we will see an escalation in trade sometime over the next 3 months. I do think that if we don't get a trade resolution in the next 6 months, that there's likely going to be no trade resolution in 2020, and we'd likely be looking at the next administration for some progress on this front.
So real quick, let's see how the audience stacks up on that. So a majority of you, well over 55%, answered 2020. Just under a quarter of you at 19, and then a small percentage of you actually said no deal.
The other reason why I think we could have a recession is because of slower global growth. Now, this looks at semiconductor trends, and semiconductor sales tend to lead global earnings per share by 3 months. And you can see that the slowdown that we've had is much deeper than what we saw in 2015 slowdown and then also 2012 slowdown also. So we think weaker global growth is going to be upon us, and a lot of this weaker global growth is originating out of China. Chinese weakness has been led because of the deleveraging campaign that Chinese leadership has been doing since the early part of 2018. And we think it's likely to get worse than better at this point. You're seeing weakness in exports. You're seeing weakness with consumers. You're seeing weakness in broad swaths of the Chinese economy, manufacturing investment as well. So I think things will ultimately have to get worse before they get better. Now, I know the Chinese have done a lot of stimulus in the last year and a half. In fact, they've done almost 90 easing moves. But this has been more of a rifle approach. They're targeting specific areas of the economy. In order to have a broad-based reacceleration of global growth, they need to go to what we call shotgun-style stimulus, a stimulus package similar to 2008, a stimulus package similar to 2015 and 16, where they go and ultimately reinvigorate the shadow banking system. That's specifically housing and then also infrastructure spending. So right now they've supplied a lot of credit, but they just need to boost demand. And ultimately, we think the Chinese, if you start to see slower growth for the rest of this year, which is our base case scenario, will ultimately go to that shotgun-style stimulus in the fourth quarter this year or maybe the first quarter of next year. But nonetheless, a recession can be caused by a decrease of both business and consumer confidence here in the U.S., leading to lower spending, but also a continued deterioration of global macroeconomic data, most of which emanating from China and branching out to areas like emerging markets and also Europe. So that's the recession-based scenario. Let's look at the slowdown scenario. And coming into 2019, we were very bullish about the equity markets because we had found two important historical analogs that very much rhymed with what we saw in 2018. The one that we think is most prevalent to today is the 1994 to 1995 period. So you can see that the recession risk dashboard at the end of 1994 heading into 95 was clearly green. And then in the middle of 1995, we had a yellow signal, similar to today. Also, in the beginning part of 1995, the first 6 months, the markets were up 18.7%. This year, the markets are up 18.5%, so that very much rhymes. Also, in the middle of 1995, you had two Fed rate cuts. You had a rate cut in July, and you also had a rate cut in December. Powell has foreshadowed that we are going to get a rate cut in July, and we're also going to get likely a rate cut sometime in September as well. So there's a lot of parallels here.
Yeah, so the third polling question we had, Jeff, was, basically after a strong first half return of 18.5%, what will the S&P 500's total return look like by year end?
And so there's a lot of parallels to 1995 right now. Again, if this is a slowdown, I think it will likely follow 95's playbook. However, there's two important differences between 95 and today. The first one is that you have seen much more defensive leadership today versus 1995. In fact, areas like financials are doing very well in 95, while financials have lagged the broader market so far this year. The other thing is that 10-year treasuries rose that year rather than declined. So because you have these important differences, there are the reasons why the 95 analog may not work out this way. But the other positive or similarity that I'm seeing right now is with the yield curve. The yield curve flattened relentlessly in 1995, but the very back end of the curve, the 10-30-year part of the curve, that actually flattened and then steepened back out, which signaled a slowdown, not an outright recession. And I know that the 3-month T-bill and the 10-year Treasury has inverted, and it's been inverted roughly for the last couple of months. But the very back end of the curve, the 10-30 part of the curve, has actually steepened out since September. So again, this is another feather in the cap for a slowdown rather than an outright recession. Another reason why this could be a slowdown is because of this slide right here. If this is a non-recessionary correction, they tend to be followed by strong rebounds. And we've had 6 non-recessionary corrections, 7 if you include 2018, since 1984. Now, importantly, 6 months after the lows, the market was up, on average, 25%. Right now, 6 months after the lows that we saw, the 2018 drawdown, the markets are up exactly 25%. So we're right on par with what you've seen with a non-recessionary correction. Now, importantly, if you look at the next 12 months, the next 6 months after that, so 12 months after the lows, on average, the markets are up 30% from a 25% level 6 months after the lows. So the easy money has likely been made. We think we're going to see some volatile price action, and although the markets will go up, we think we need to temper expectations as ultimately how far those markets will go up for the back half of this year. And the other reason why this could be just a slowdown rather than an outright recession is that the post-midterm election year tends to have very strong performance. This is the last 17 years of midterm elections. The year following, you've had 17 positive years of returns. On average, your return was 15.3%, and the key reason for this is that you've never had a recession in the third year of a presidential cycle, and that happens to be the year following the midterm election. So because of all of these slides and this historical analogs that we've talked about, I think that a slowdown is a very strong possibility at this point.
Yeah, so consistent with some of our bullish answers earlier today, over 50% of the polling audience actually chose, let's call it answer C, somewhere between 15 and 25%, Jeff.
15 and 25%. Okay, so we're kind of right here.
Right line.
A little bit less or a little bit more than where we currently stand. And the other reason, if we have a recession, the one thing that would be good for the economy is that it would likely be a shallow recession, economically speaking, because leverage has not built up all that much in 2 key areas of the economy: corporate debt and then also household debt. Now, the blue bars there are corporate debt, and the gray bars are household debt. And you can see heading into the last 7 recessions, the 5 years prior to that, on average, corporate and household debt has gone up 15% of GDP. If you look all the way to the right, even though corporate debt has been rising over the past 5 years, consumers have taken this opportunity to delever, and a lot of this deleveraging has taken place in the housing market. So although there are areas of consumer debt that have risen, like student debt and also autos, household debt has more than outweighed the increase of those debt levels. And the net debt between these 2 cohorts is positive 1.5%. So again, if we're going to have a recession, leverage isn't extreme, and that recession will likely be shallow, similar to the one that we had back in 2001. The last reason why this could be a slowdown rather than a recession is because of the consumer. And the consumer is in a very good position from both a labor market and then also a balance sheet perspective. And this looks at job openings versus unemployed. And we talked about this just a second ago. Coming out of the great financial crisis, for every job opening, there were 7 people that were unemployed trying to get that job. Because of a 10-year expansion, today we have more job openings for the first time in U.S. history than people that are unemployed, 1.6 million more job openings. And in fact, your average consumer is making 4.6% more in their paycheck this year than they did last year. That's total cash compensation, and we get that number because average hourly earnings have increased 3.1% year over year, and total hours worked have increased 1.5% year over year. So if you put those numbers together, again, total cash compensations for your average American is up 4.6%, which gives them the ammunition to continue spending because consumer spending is 70% of our economic activity. And the other thing that you can look at is their balance sheets. Now, when people say that household debt is at record levels, that's absolutely true. Consumer liabilities is at $16 trillion, which is $1 trillion more than where we were back in 2008. However, if you look at debt only, it's only looking at one half of the coin. You need to look at assets as well to get a true picture of the financial health of the consumer. And on the right-hand side, if you look at household leverage, which is debt, assets and debt, and their combination of one another, you can see that household leverage is the lowest it's been since 1985. So the consumer who's been the workhorse of this entire expansion is in a good position to continue spending. Now, whether or not this goes recessionary or this is something akin to a slowdown that we saw in 1995 remains to be seen. However, you do want to stay invested in the equity markets for the tail end of an economic cycle because the final stages of a bull market tend to be some of your best returns. You can see that in the final year of a bull market since 1975. Your final year of returns has on average been 26.9%. So at the end of an economic cycle and the end of a bull market, people get euphoric, they get greedy rather than fearful, and you tend to see outsized equity returns. So again, we're at a crossroads. We're looking very closely to see whether or not the data deteriorates or accelerates from this point. Now, with the 3 false yellows that we've had, you've seen an acceleration fairly quickly when we've turned yellow, sometime between 3 and 6 months. But if we do see a continued deterioration, this could be the beginning of the next recession as we head into the 2020s. So that's all the prepared comments that I had. Maybe I'll turn it back over to you, Brian, to see if we have any questions and answers.
Sure. Sounds great, Jeff. And as always, thank you for your comments today. I always learn something as I sit here and listen to you speak. So, let's go to Q&A. And look, while we're compiling the questions, I wouldn't mind, if you wouldn't mind, I'd like to direct your attention to one of the themes in the presentation around volatility. So my question is, if the markets do get choppy and we see some downside pressure, where are the places to quote unquote hide in the equity markets?
Yeah, so again, volatility is going to be higher for the remainder of this cycle, no matter which fork in the road we take. There are several areas of the equity markets that you can hide out in and actually do pretty well, all things considered. And to be able to identify those, we looked at the last 7 major market drawdowns. These are drawdowns of 15% or greater. And on the left-hand side, that's the relative performance of every sector versus the market during those drawdowns. And the 3 key sectors that you wanted to have an exposure to were consumer staples, utilities, and healthcare. Surprisingly, consumer staples beat the market on average by 20% during each one of those drawdowns. The areas that saw the biggest decline were financials and information technology. Now, if you look to the right-hand side of the chart, this is looking at it from a different perspective. This is your hit rate. How many times did you outperform during those 7 time frames? Again, the same 3 that you wanted from a relative performance were the best that you did on a hit rate, which was consumer staples, utilities, and healthcare, all outperforming 100% of the time. Now, I know we may be heading into a recession and the next market crash. However, this is a good slide that talks about the powers of staying invested. And we looked at every decade since the 1930s and what that price return of the decade was, and we compared that to an investor that happened to miss the 10 best days of market action for that decade. And if you see at the very bottom of the page, it's since 1930, on average per decade, an investor has made 112%. And if you miss the 10 best days of that decade, your return falls all the way down to 42%. So a lot of those best days of returns happen at the end of a large sell-off when the market recognizes that the recession is coming to an end or that drawdown is coming to an end, and you have robust rallies off those lows. So it's important to stay invested because if you don't, your overall returns are going to be drastically reduced. There's a great statistic out there that since 1936, if you were a tremendous market timer and you were able to consistently sell 10 months prior to the market peak and you were able to consistently buy 10 months after the lows, you would have been worse off than an investor that stayed the course the entire time. So again, I know all of you know these concepts, but it's important to remind your clients that staying invested is paramount even if volatility is rising and we ultimately have a recession.
Long-term investing. Thanks. So another one of the questions came in around Fed policy. So, and I would argue that we hear that all the time. What are our views on the Fed? And I'm sure our clients ask them the same question. So maybe quickly, what is your expectation in terms of Fed policy this year? You know, no cuts, one cut, et cetera.
Well, I think a cut is a foregone conclusion at this point, given Fed's comments. And this isn't surprising, actually. If you look at the last 8 tightening cycles that we've had, on average, the first cut comes less than 5 months after that final hike. It's 4.7 months, 5 months to be exact. Usually the Fed overdoes it from a tightening perspective because monetary works with long and notorious lags, and they need to reverse course very quickly, and that's obviously what has happened so far here in 2019. So I think a July rate cut is a foregone conclusion. Some people are talking about a 50 basis point rate cut in July. I think that's a little bit aggressive. The only times that the Fed has cut 50 basis points has been going into a recession. If you think about 1995 or 1998 when they did their rate cuts, it was a 25 basis point rate cut, followed up by more 25 basis point rate cuts after that. And given the strong jobs number that we've had and given the retail sales print that we've had today, I believe it's likely going to be a 25 basis point rate cut, followed by another rate cut in September to uninvert the yield curve and give the economy a little bit more breathing room. Given the fact that inflation is nowhere to be found at this point, having tight Fed policy doesn't do the economy any good, and they'd rather err on the side of caution by giving a little bit of breathing room versus potentially choking this off and inadvertently causing the next recession. So the one thing I'll mention is that the markets right now are pricing in 100 basis points worth of rate cuts between now and the end of 2020. I think 100 basis points of rate cuts is a little bit of an aggressive forecast. I likely think between now and the end of next year, assuming no recession and that this is just a slowdown, I think 50 basis points of rate cuts is all that we'll ultimately get, and both of which will be happening here at the back half of the year.
Great, thanks. You know, representing ClearBridge, a global equity manager, we often get asked our thoughts on Europe, and one of the questions that came in is specifically around European equities. So specifically, you know, in your opinion, will European equities continue to lag the U.S.?
It's a great question. I mean, it's been a painful trade being invested in European equities, and I think we may be close to an inflection point, and that has a caveat to it, of course, if we don't go into a global recession sometime over the next 12 months. And there's a lot of reasons to be positive on EU equities. Right now, you had a nomination of the former French finance minister and IMF head, Christine Lagarde, as the new ECB chief, replacing Draghi. There are a lot more hawkish members that are out there that could have been nominated, and if she actually gets the endorsement, I think that's a very bullish development for the Eurozone, broadly speaking, because she's been very supportive of the QE program that Draghi did a number of years ago, Draghi's do whatever it takes speech to save the euro, and she's also urged Berlin to loosen its purse strings and make more pro-growth investments, more fiscal stimulus. So I think that's one reason why you could be bullish on the EU. Another reason is that you have the nomination of Germany's Ursula von der Leyen as president of the European Commission, and she's been very for European integration. And so has Lagarde. So if you get both of these individuals as the two most powerful people in Europe, you're going to have more integration and ultimately a stronger union coming out of Europe. And then lastly, Rome was obviously a tail risk that could have materialized over the last couple of months, specifically with their budget confrontation. However, that has now gone to the back burner, and you've seen a nice bid into Italian 10-year bond yields, and a lot of those tail risks seem to be off the table. And also, the Italian government has pledged to try to hit lower deficit targets than expected, at least expected 3 to 6 months ago. So those tail risks are slowly going to the back burner. And the last thing is that Deutsche Bank has done a restructuring, which may mark an important turning point for EU banks. And if you look at European versus the U.S. outperformance or underperformance, it has really been driven by leadership of U.S. tech versus European financials. Now, that chart looks at U.S. tech versus Eurozone banks, and it also looks at the MSCI US versus the MSCI Eurozone, and you can see they're mirror images of one another. So it really comes down to US tech versus European banks. And that's because the US markets have much more tech exposure, Europe markets have much more financial exposure. Now, if you're going to see a healthier banking system originating out of Europe, that's one reason why you can see European leadership start to persist here, especially if those tail risks are moving to the back burner. Also, if you think about U.S. tech, some of the larger tech giants are coming under scrutiny for regulation. A lot of them have reached their critical mass as far as how much they can grow in a particular market. Ultimately, I think it's going to be a close call with U.S. tech versus Eurozone banks, especially if we have a reacceleration of global growth. But this certainly could be a catalyst for Europe to at least perform in line with what we've seen or likely to see with the U.S. in the upcoming months. And the last slide I maybe share with you on the European markets is this one, which I find very interesting. Now, if you're not familiar with the IFO Expectations survey, it's just the business survey that's given to Germany. And the DAX is the German version of the S&P 500. Now, when you look at IFO Expectations, when it's very bearish, which is all the way to the left-hand side, when the outlook is bearish, that means that it's usually priced into equity markets, and your forward one-year returns, when you're below 96, which is where we are today, your forward one-year returns of the DAX is 17%. As you move forward and people get more and more bullish about the future, you can see that your forward returns tend to decline. So, again, absent having a global recession, if the Chinese stimulus package, the shotgun-style stimulus that comes into effect sometime in Q4 happens, I think there's a very good opportunity for European equities to re-rate higher and at least perform in line, if not better, with the U.S. equities over the next, call it, 12 to 24 months.
Thanks. So going back to some of the comments you made on trade, and that was obviously one of our polling questions, we got a number of questions centered around China. So one of them is this. Any thoughts on excess manufacturing capacity in China and their need to keep people working even if it's not profitable?
I think if you think about communist leadership, they don't care about maximizing economic productivity, they care about maximizing employment, stabilization. So I think that is a problem that is prevalent over in China and will continue to be prevalent under a communist regime. That being said, you've seen a lot of deleveraging in China since the 2015 and 16 slowdown. A lot of state-owned enterprises that had excess capacity have been taken out of the system. There certainly is a lot of excess capacity still in the system, but they are slowly purging that so they don't cause a big crash in their economy all at one time. But I do still think that's going to continue to be an overhang for a lot of manufacturing pricing, broadly speaking, until the Chinese do what they need to do, which is right-size their economy, move more towards the private sector, and stop the overcapacity issue that you're seeing in the state-owned enterprises. But unfortunately, they can only do it very slowly, and it's going to be more of a methodic move towards that direction rather than something that's going to be abrupt. If they do it abruptly, even though the deleveraging campaign has been geared towards this area, it would cause their economy to crash due to the excess capacity of debt there. So I think they're making the right steps. If they do shotgun-style stimulus, however, in Q4 and Q1, they're undoing a lot of the positive deleveraging steps that they've been able to maintain over the last 18 months, give or take.
A lot of the questions that have come in literally are about overseas. So staying on that theme for 1 second, thoughts beyond China. In other words, what other meaningful global factors could impact a slowdown versus a recession?
Well, I think a lot of people would probably say Brexit. Obviously, that's the odds of a hard Brexit have risen substantially, with Boris Johnson now likely taking the helm of the Brexit negotiations. One thing I'll mention is that there is a difference between the EU and the Eurozone currency. They have the pound over in Great Britain. They don't have the euro. So they're just looking to leave the EU or stay in the EU. And if you do leave the EU and there is a hard Brexit, the trade rules would just simply shift to the rules that apply between the European Union and all the other countries under the World Trade Organization. It'd be similar to ones that apply to the EU and the US, the EU and China, the EU and Japan. So it's not that big of a deal. However, the European Union ran a $90 billion surplus with the UK last year, actually in 2017. So if you have a hard Brexit, I can guarantee you that there's going to be lobbyists filling up every capital to make the trade rules go back to where they were previously before a hard Brexit, to have that surplus continue to be maintained. But nonetheless, if you do have a hard Brexit, even though the markets have had over 3 years to anticipate this, I would think that could be a risk-off type of event that could cause international markets, and specifically Europe and UK, off anywhere from 5 or 10%. It's kind of a known unknown, but nonetheless, I think there would be a market gyration with that. A Chinese hard landing is another one. I think they've done enough stimulus to have their slowdown be very manageable, which is why growth hasn't fallen off a cliff yet. But if they are reluctant to do shotgun-style stimulus in Q4 or Q1, I think that could be something that could affect global markets substantially. Outside of that, I don't see any real tail risk outside of a war maybe that could cause financial markets to sell off aggressively from here. And even though we are having some issues with Iran, I think the odds of outright military confrontation there are relatively low.
Super. So bringing it back home for a second, are there any potential excesses in the U.S. economy that concern you?
Well, corporate debt has risen substantially. The area of corporate debt that you've seen a large increase in is the triple-B space. Triple-Bs have risen from 1973, it was 9% of the investment-grade market. Today it's 44%. So there's an old saying that I say with our clients, it's not your grandfather's investment grade. So my concern is that if and when we go into a recession, and I should say when, because eventually we will have a recession, yes. My fear is that a lot of these triple-B companies that are on the cusp of high yield will get downgraded and they will become fallen angels. Now, the U.S. investment-grade market is around $6 trillion. The junk market is $1.3 trillion. So it's a much liquid market, a much smaller market, and importantly, a lot of pensions and financial institutions cannot own high-yield paper. So if you have some of these large downgrades, that could cause distortions in the credit markets, and it won't be the ones that just are fallen angels that get hit. It's going to be anybody that has a questionable risk profile where you could see contagion and some financial market disruption. That's one area that we've seen some excess that does concern me as we move later into the economic cycle. One could talk about U.S. debt levels, but although debt levels have risen substantially and our debt-to-GDP ratio is around 105%, give or take, there's a bigger runway for U.S. debt levels. If you look at Japan, for example, the Japanese have a debt-to-GDP ratio of close to 240%. So yes, our debt levels here in the U.S. have risen. Debt levels are going to be rising for the next 20 years, especially as more baby boomers go on Social Security and Medicare. But I don't necessarily see it being an issue, not at least until our debt levels rise substantially from this point. Any other areas of excess is not really obvious to me at this point, other than, I would say, corporate debt.
Thank you. So, the inverted yield curve, I can tell you we get questioned on this quite a bit. Do you view this as potentially a false signal?
Yes, there is the potential for it. The yield curve is not infallible, right? Everybody thinks that the yield curve is the all knows everything. It's never been wrong, but the yield curve has been wrong in the past. See, this chart, you can see that it has predicted 7 out of the past 7 recessions going back to the 1960s. However, you had 2 false positives. You had a false positive in 1998, and you also had a false positive in 1966. So, yes, the yield curve is a powerful signal, but it isn't infallible. Also, the depth of the inversion tends to be a very good indicator of whether or not you're going to have a recession. Usually you need to see an inversion of 50 basis points or greater for it to have a meaningful predictive capability. The deepest inversion that we've had here has been around 25 basis points. So it's been a very shallow one. And if obviously Powell and company cut in July, which we expect them to do, that yield curve will be uninverted at that point, and it'll have a little bit of breathing room. But yes, I do believe, given the fact that we've had extreme monetary accommodation, things that we've never seen before, like zero interest rate policies, QEs, negative interest rate policies abroad, that the efficacy of the yield curve may be compromised. But I'm a believer that until the yield curve doesn't show us a recession, I'm going to still believe in its predictive capabilities. But given that it was a shallow inversion, all things considered, and it wasn't a very long inversion as far as time is concerned, I think this one could be a false positive like 98 or 1966.
Well, so while we're looking at questions and aggregating some similar questions, there's been a number that have come in regarding the slide that you posted earlier highlighting like the best and worst days.
Yep.
Can you provide maybe another quick review on that?
Sure. Let me just find this. We have quite a number of slides, as you guys are all familiar. There we go. Yeah, so this looks at the price return of every decade since the 1930s, and then, which is the first column on the left-hand side there, or technically the second column. And then the column to the right of that, that's what your price return would have been if you excluded the 10 best days in that particular decade. Now, at the very bottom of those two columns, you can see the average return of a decade, and then the average return to the right of that of a decade if you excluded the 10 best days. So on average, a decade return was 112%. If you excluded those 10 best days, it drops all the way down to 42%. So if an investor missed those 10 best days per decade, you would have seen 70% lower returns on average per decade since the 1930s. On the right-hand side, this is just looking at it from a different perspective. That's the annualized return of the markets in a particular decade. And to the right of that, if you exclude the 10 best days, that's the annualized return of the market per decade. And at the bottom, you can see, on average, you've had an annualized return of 6% in the market, but if you take out those 10 best days, it drops all the way down to 1%. So again, staying invested through volatile times, and a lot of these market rallies that you see off the lows are some of the best returns that you're going to have as an investor. So again, fork in the road here, slowdown or recession, you still want to be invested. And then another slide here that we put that I think tells a similar story is that volatility doesn't equal a financial loss until you sell. This is looking at market returns since 1983, and the median annualized total return that you've seen is 15.1%. However, in order to get that total return, you had to endure an intra-year decline on median of negative 9.3%. So volatility is unfortunately a part of investing in equity markets. You need the volatility in order to get the good return at the end of the day.
Any thoughts, perspective on the U.S. dollar?
Yeah, we believe that the dollar is likely in a peaking fashion and likely to move down over the next 5 to 6 years. And the U.S. dollar goes in long-term cycles, 15-year cycles from peak to peak. So since 1971, you've had 3 long dollar cycles, peak to peak. We believe that we saw a dollar peak in late 2016, and we're in a 5 to 6 year downtrend of the U.S. dollar as you move into the 2020s. One of the key reasons is going to be the bloated deficits that we have here in the U.S. Now, this is the budget deficit and the trade deficit. You can see that they lead the U.S. dollar by 2 years, meaning the larger the deficit, the more it's going to weigh on the dollar 2 years later. And the deficits are going to only get bigger, again, as the baby boomers enter into the retirement phases, and we potentially have a recession where the deficits are going to blow out substantially from levels that we're currently at. You know, it wouldn't be a surprise to me if we have a deficit somewhere in the $1.5 trillion range during the next recessionary period. In fact, if you look at our budget deficit, there's only been 2 times in the post-World War II era where as a percent of GDP, our budget deficit was higher than where we are today. It was in 1983, and then it was also after the great financial crisis. So to have a budget deficit this big at 5.1%, give or take, is a little alarming that deficits are likely to only get bigger, especially when the economy rolls over.
Thanks. So, look, you touched on this throughout the presentation, but are there any specific concerns about current equity market valuations that you'd like to touch on?
No, I think equity markets are a little overvalued, but I don't think that equity markets are stretched right now, especially when you take into consideration where bonds are trading at. Now, usually at the very end of an economic cycle, you have a close correlation between the equity markets and the bond markets. And so we're looking at, instead of looking at it from a PE perspective, all we do is we flip the letters around and we put the E on top of the P. It's called the earnings yield of the market. It's a way to convert the market to a bond. And we looked at the 3 longest economic cycles that we've had in U.S. history, the end of the run of the 1960s, the end of the run of the 1980s, and then also the end of the run of the 2000s. And you can see that the earnings yield of the market minus the 10-year Treasury at the peak has historically been negative or substantially negative at the end of the 1980s and the end of the 1990s run. Today, it's positive 3.2%. So that would signal that bonds are expensive and equity markets are inexpensive on a relative basis. So I think even though valuations are slightly above the long-term average, I think that valuations can continue to move higher given the fact that the bond markets are trading at such a cheap discount, and the discount rates that you're going to embed into the valuations of the equity markets are going to be lower than what they've been historically. So yes, there are pockets of the equity markets that are overvalued, but I think broadly speaking, the equity markets are roughly fairly valued for where we are at this cycle and where rates are.
So you had mentioned it. I think it's something that's on top of mind for all, the U.S. election. So our final question centers around that. And specifically, in your opinion, are there any markets that could be held hostage by the upcoming presidential cycle?
Well, let me just get to a slide here very quickly. Well, if you talk about the election, it's too early to tell who is going to be our president. Obviously, we're nowhere close to finding out who the Democratic nominee is going to be. And then we're about 16, we are maybe 16 months away from the election. But I think it actually, to figure out who's going to win the election, I think it comes down to the economy. And this looks at every first-term president and their reelection bid. And it looks at, you can tell that the only 3 first-term presidents that didn't get reelected were ones that had a recession 2 years prior to that recession, and all 3 of them were the only ones that had a material rise in the unemployment rate in the year of the election. They are H.W. Bush, which is Bush Sr., you have Jimmy Carter, and then Gerald Ford. So thinking about the election, again, we don't know who the Democratic nominee is going to be. I think the ultimate barometer of whether or not Trump administration gets reelected is whether or not the economy is healthy and whether or not the recession is upon us. So again, it's a little bit too early to tell what the economy is going to be over the next course of the year. But I think the economy that's likely to see the most change from the outcome of the election would likely, obviously, be the U.S. because it's going to directly affect U.S. policies.
So, Jeff, before we close, first of all, let me say thanks once again. Excellent presentation, phenomenal bullet points that our clients can use in speaking with their clients. And one thing I would like to point out is, while the polling questions were obviously something we put together, the questions you all asked were coming in live. And what I found really interesting is that whether the slides in our deck and the bullets that Jeff spoke on inspired the questions or not, it absolutely points out the fact that if you have these types of questions, offline before calling your clients, these slides can absolutely help inform you, help educate you and your clients, and whether that's just having a conversation with your clients or, as I said earlier, making adjustments or final portfolio decisions, changes or not. So these slides are obviously so helpful. So we care about you, and more importantly, we care about your feedback. So before you hang up or click off, we'd asked if you could just stay on maybe 1 to 2 more minutes and answer one final polling question that we're going to send out to you, which is basically asking the question, did you find or do you find this presentation and probably AOR in general useful and productive? So this does conclude the webcast, and once again, on behalf of LEG and ClearBridge Investments, we want to thank you for your time and your interest in the anatomy of a recession. Again, we know your time is valuable, and we hope you found this valuable. We believe in this program. You're going to hear from every sales individual at this organization that it has merit and that it really can help you more than anything else from a partnering standpoint. So it's valuable, it is powerful, and I think it's very relevant. And, as you think about asset allocation or you rethink your current asset allocation models, whatever that time is, whether you believe this is a slowdown or the beginnings of a recession, as Jeff said, we are likely getting to the latter stages of this cycle. So this might be a great opportunity, and again, per a number of Jeff's comments today, to potentially upgrade your portfolios to, for example, more defensive-oriented asset classes with maybe a higher quality bias. So quickly, two solutions that a lot of our advisors, many of you on the phone and listening in and on the webcast now, have found to hold those types of attributes are ClearBridge's dividend strategy and our large cap growth portfolios, which have historically had strong downside capture ratios and risk-adjusted returns when volatility exists or rises, as Jeff had commented on several times. So with that, again, Jeff, thanks so much, and if you wouldn't mind answering that final polling question, we'd really appreciate it.
And thank you to all of our participants for joining us today. We hope you found this webcast presentation informative. This does conclude our webcast, and you may now disconnect. Have a great day.